Welcome to Startup Hack. Today we're going to talk about why the Fed wants corporate America to have a hiring freeze. And we're going to talk about the chorus of those wanting a weaker labor market is getting louder and louder. Now that sounds really strange, so let's go ahead and dig in and get started with that today. Welcome to Startup Hack. My name is Spencer Tomlinson. I am the CEO and co-founder of CleanRouter, as well as many other products. Here are some lessons that I've learned building a successful business while challenging startup norms. My challenge is to push you to rethink startup success. Welcome to Startup Hack. All right, let's go ahead and dig in today. So the chorus of those wanting a weaker labor market is getting louder and louder. After the recent job numbers were released last week, Bank of America analysts said in a note that they are essentially rooting against the home team and hope that the numbers stop being so strong. As higher wages contribute to inflation, the Federal Reserve appears to agree. Quote, Chair Powell keeps mentioning the relationship between the high level of job openings and wage price inflation, wrote an analyst in the newsletter Tuesday. Quote, he's not talking to investors, he's talking to corporate America, and his goal is to have companies essentially institute a hiring freeze and end the cycle of paying up for new hires. So last Wednesday's economic release of consumer prices, or CPI, shows inflation rose more slowly in April, which was at 8.3%, compared to March, which is at 8.5%. While the report was expected to have shown a March peak, there wasn't much good news. Quote, substantial decline in the annual rate of inflation are unlikely to materialize until there are significant improvements in geopolitical tensions, speaking about Ukraine, supply chain strains, and labor market shortages, wrote ING's James Knightley in a note after the release. Unfortunately, there's little sign of any of that happening soon. TD Securities analysts agreed, noting that the report should be of concern for the Fed, given price gains in core segment appears to be spreading. Now, I found this chart on Yahoo News, Yahoo Finance, that I really liked, and I wanted to share it with you and talk a little bit about this. So one of the things that's really interesting to me about this is that we can see that, job openings versus hires have followed each other around for the last 20 years. And I find this chart to be really interesting because job openings were always under hires. There was more people, and this shows where you have a labor shortage, right? So there's, there was more people being hired than there were job openings, and so there was more. And so this is, was where unemployment was difficult. Then around 2015, we saw the number of job openings dramatically go up, and we saw there was more openings than there were people to be hired. Now in COVID, we saw this kind of bounce around a bit. But then we saw this radical climb since COVID. Now, these number of job openings are happening because of a couple of reasons. One, we're seeing that companies have been funded with a very low interest rate so they can hire. And I think a lot of this also is coming from stimulus funds, where there's been a lot of stimulus pumped into the economy to make sure that job growth is happening. Now, what they've done is they've pumped way too much stimulus into the economy, in my opinion, and I think we're going to see some data to prove this, and I think this data proves it, where we see job openings are absolutely off the charts, and it's making it so that the hiring, which has followed a fairly normal trend, if we look here, you'll see that hires are actually in there versus job openings, which are off the charts. Companies are trying to get out, and this is causing inflation because as more and more of those job openings happen and there's not enough bodies to fill them, people are offering more and more money, which is causing an inflation to happen between these two. So this data right here I found really handy and really fascinating. So let's dig back in here a little bit to some of the other data. According to the consensus view of economists and analysts, shocks to commodities, supply chain issues, and the red hot and very tight labor market are keeping inflation high and unpleasant. But it's the market that appears it's the labor market that appears hard to vanquish. While supply chain problems and big price shocks have been easing, quote, we see no such let up when it comes to labor cost pressure, Bank of America said. Employers can't find people to fill open positions. Tons of people are changing jobs, and looking ahead, there is no sign of stabilization. The only way to get stabilized, according to this analyst, the only way to get stabilized inflation is to use the monetary policy hammer to hit stock prices. Quote, the Fed's goal is to convince corporate America to enact a short-term hiring freeze, and it will keep raising rates and talking about aggressive monetary policy until that happens. Lower stock prices are the Fed's way of convincing C-suites and boards to do that. Now, the Fed has a blunt force tool called rate policy, and that's what we're going to talk about. So Fed Powell has been focused on the ratio between job openings versus unemployment workers and the core personnel consumption expenditure price index, which measures inflation. So Chair Powell mentions the ratio several times in last Wednesday's press conference, said Colas, who said job postings needed to drop from 11.5 million to around 8 million to get to normalcy. The only way that this would be is if there was some sort of company freezes. Freezes typically happen when C-suites and boards decide that business conditions have become very uncertain. The Fed doesn't have a seat at those discussions, but it does have the blunt force tool of rate policy and its effects on stock prices. Chair Powell has made it clear that he wants to see openings decline. So the big question is by how much and when will it be enough to whip out the recession word. Harris wrote, if the strength stays at 200,000 openings per month at the pace we've seen, the Feds will need to push job growth down to about 25,000 per month, which is about an eighth of what it's currently running at right now. But Harris added, if the labor force has slowed to a more trend like 100,000, then they will need to push job growth to a negative 70,000. That is, they would need to trigger a mild recession. So the whole premise of this article is that we're going to end up needing to trigger a recession in order to get inflation back under control. And so it's interesting where recession scares a lot of people. And in this case, it is going to be interesting for us small business owners and us entrepreneurs, because what this means is as we're competing against corporations that are hiring at a literally unprecedented pace. And they're hiring at that because interest rates are low, and so they're able to borrow money for next to nothing, and they're using that to fund the hiring of their employees to continue to grow their businesses. But they're also doing that also allows them, as they're doing getting this negative interest, this very low interest rates, and so by causing what it's doing is that gap that we saw is causing part of that inflation because they're having to bid against each other to get into this razor tight labor market. So with the labor market and with the cheaper money, I also think we're seeing the effects of a lot of stimulus funds that were pumped in. I think a lot of those stimulus funds helped prop up jobs that frankly a natural effect should have allowed to go away. And so I think in the process of that, what we're seeing is the result of that. And so we're seeing that tighter labor market. So I think we're going to have to see some type of corrections. And in order to do this, this is going to be an interesting play for us as entrepreneurs. Small business loans are going to become more expensive as interest rates grow up because they're going to go up. When the Fed raises interest rates, it will raise interest rates on all loans, credit card debt, small business financing, all loans will get more expensive. And so as that becomes more expensive, more and more businesses will turn to equity financing, and equity financiers will know this. They've been very competitive, and they've been trying to do everything they can to get people to finance their businesses on equity. But by when interest rates go up and now suddenly lending becomes more expensive, it will drive more people to go out and go to these equity holders. So we're going to see an interesting change and this is going to become an interesting time to be an entrepreneur because ultimately the Fed is trying to build scarcity. They're trying to create some fear in the market. We have to have that in order to be able to combat inflation, and that's what they're finding with this. So I hope some of this was helpful. I hope something that I've said today has been a little helpful in your business, but I just want to make sure we're staying up to date on how this affects all of the entrepreneurs and small business owners. Make sure you like and subscribe to the channel. I always try to bring you the latest entrepreneurial news and to help you in little tips that I've given and things that I understand as I'm following the economy and latest trends and helping you and run your business. Thanks, and we'll talk with you next time.